Assalamualaikum to our lecturers and fellow friends. We will now present the differences between Islamic and conventional banking instruments. Let's get started.
My name is Nur Damia Safia binti Shaifuddin and my matrix number is 1250761, and today I will explain about the differences of conventional credit card and Islamic credit card. Firstly, for conventional credit cards, the concept based on interest or riba. In contrast, for Islamic credit cards must follow the Sharia principle, which means they cannot involve in riba, gharar or any gambling elements. Instead of interest, they use Sharia compliance contract, which is ujrah, tawaru or qard. Any charge must be transparent and cannot exploit the customer. For example, qard is a loan without interest, which means customer need to repay back the exact amount of the borrowed. For instance, if you spend 500 ringgit using the Islamic credit card, you need to repay back the 500 ringgit. But if you delay the payment, you will get a small penalty, which is 1% of the charge. And the penalty will go to the charity, not the bank itself. Another difference is in usage. For conventional credit card, it can be used for any type of transaction, whether it's halal or haram. But for Islamic credit card, it cannot be used for haram transaction, such as gambling or purchasing alcohol. In conclusion, the key difference of the two types of credit cards is conventional credit cards are interest-based and Islamic credit cards follow the Sharia principle and avoid riba. This makes Islamic credit card is a safer option for Muslims who want to manage their finance in halal manner.
My name is Nur Awatif binti Aminuddin and my matrix number is 1250748. Sukuk and bond. Sukuk is an ownership-based contract that represents ownership in an asset, project, or investment. Investors are required to have ownership of an underlying asset. The returns from sukuk are not interest. Instead, they come from rental income, profit from sale, or profit-sharing arrangements. Sukuk must also comply with Sharia principle and can be structured using contracts such as ijarah, murabahah, musyarakah, mudarabah, istisna, and wakalah. Bond, on the other hand, is a loan-based contract that represents a borrowing arrangement. Unlike sukuk, bonds do not require any underlying asset because they are a conventional debt instrument. Investors receive interest as their returns. Additionally, the fund raised through bonds can be used for any purpose, and the issuer is not required to disclose how the borrowed money will be utilized. How does both of these contracts work? Sukuk ijarah is one of the sukuk structures in Islamic finance. The issuer first identifies a suitable asset, then the SPV issues sukuk to raise funds from investors and use the proceeds to purchase the asset. The SPV then leases the asset back to the issuer, and the issuer makes regular rental payments. These rental payments are distributed to the investors as their returns. Finally, at maturity, the lease ends and the investor receives the principal back. On the other hand, a bond contract begins with the issuer selling bonds to investors who in return lend their money to the issuer. The issuer pays periodic interest to the investors, and at maturity, the issuer repays the principal amount.
My name is Maisara binti Zulkawi and my matrix number is 1251152. Okay, so right now I am going to explain the differences between Buy Bitaman Ajil, which is used for home financing in Islamic bank, and the conventional home financing. Okay, so for Buy Bitaman Ajil, it is a trade contract which is known as buy, which means in this concept, the bank must purchase the house first before they sell it to the customer at a higher price. Okay, so why bank sell it with a higher price? Because the source of profit for bank is from the markup on the selling price. Second, the bank must own the house first before they sell it to the customer, because it is a real asset-backed transaction, which is the bank must be involved in the asset purchase. So this is how Buy Bitaman Ajil works. Okay, so for the conventional home financing, it is totally different because the bank does not buy the house. The bank simply just provide loan for the customer, and the customer need to repay the loan plus interest. So in conventional, the bank source of profit comes from the interest, and as we all know, interest is haram in Islam because it is riba. So for conventional, the bank simply just the transaction between bank and the customer is purely financial, and because the bank is not involved in the purchase of the house.
My name is Nidno Afifah Fakihah binti Muhammad Zaki and my metric number is 1250632. Today, I would like to talk about insurance from Islamic perspective and conventional perspective. We have Takaful, which is a mutual protection scheme based on Sharia principle. Takaful is built on the Islamic concept of mutual cooperation and shared responsibility. Each participant contributes money into a risk-sharing pool, not as premium for personal gain, but as donation to help any member who faces a loss. The guiding principle is that the community protects one another. The main objective is to provide protection through mutual cooperation, solidarity, and shared responsibility. For the conventional, a commercial contract between insurer and policyholder, which is conventional insurance operate on commercial risk transfer model. The policyholder pays a premium to the insurer, and in return, the insurer promises financial compensation for the losses. This relationship is for profit, where the company aims to maximize return for the shareholder. The objective is to provide financial compensation based on contractual obligation and profit generation. Next, we move to the key principle, which is in Islamic we have tabarruk and ta'awun. Tabarruk is a donation to help any member who face a loss, and ta'awun is share responsibility and solidarity. Also, fund is owned collective by participant, and risk is shared among participants, which is if one person suffer a loss, the claim is paid from the mutual fund, not from the operator money. Also, surplus may be returned to participants as reserve. In conventional, we have riba, gharar, and maisir. For the riba is interest-based investment. Gharar is uncertainty about claims, payment, and the actual benefit. Maisir is gambling like element where one party may gain and the other lose depending on unpredictable events. Next is premiums become the property of the insurer. Risk is transferred from policyholder to insurer.
My name is Nofara Alisa binti Azhar and my matrix number is 1250772, and I will explain about the differences between mudarabah in Islamic finance and conventional investment. First, mudarabah is a profit-sharing partnership between Rabbul Mal, the capital provider, and the entrepreneur, which known as mudarib. On the other hand, conventional investment refers to allocating funds into assets such as stock and fixed deposit with the aim of earning return through interest and capital gains. Other than that, mudarabah is interest-free, which promotes risk-sharing and limits investment to halal and ethical activities. Meanwhile, conventional investment is interest-based, where it also allows speculation. In mudarabah, the Rabbul Mal will provide capital, while the mudarib manage the business. If the business generates profit, it will be distributed according to the per-acre ratio. And however, if a loss occurs, it is fully absorbed by the Rabbul Mal, whereas in conventional investment, investors place funds into various financial instruments, and the return may be fixed. And lastly, mudarabah is fully Sharia compliant, where it prohibits riba, gharar, and maisir, while conventional investment allows interest and permits non-halal transactions. Let's move on to the next presenter.
I am Alfa Bushra binti Abdurrahman. My matric number is 1250211. I will explain the differences between murabaha and conventional loans. First, the definition of murabaha. Murabaha is a sale where the bank buys an asset and sells it to the customer at a higher price with a great profit. For conventional loan is when a bank lends money and the borrower repays it with extra interest. Second, nature of contract. Murabahah is a sale contract involving an actual asset, while a conventional loan is simply a money lending contract with interest. Next, source of income. In Murabahah, the bank earns profit through a fixed trade margin. In conventional loans, the bank earns interest which is not linked to any asset. Then, asset involvement. Murabahah always involve a real asset, while conventional loans do not require any asset. Next, ownership and risk. In Murabahah, the bank owns the asset first and bear risk until sale. In conventional loans, the bank does not own any asset and bears no risk, which means the borrower carries it all. The last one is Shariah compliance. Murabahah is fully Shariah compliant by avoiding interest, while conventional loans involve riba and are not compliant.
All in all, the crucial difference between Islamic and conventional banking instrument is governance structure, which means the Islamic is supervised by Sharia Advisory Council, Bank Negara Malaysia, and International Sharia Committee. Conventional governance is purely commercial and regulated only by financial authorities, not a Sharia body, which is no screening is done for Islamic compliance. That's all from us. Thank you.